So is it a good report or a bad report according to the stock market? Pretty bad. Yeah, that's pretty seriously bad report. So what did the unemployment rate do? No, it actually fell. That was one of the good news. One of the good news in there. The unemployment rate did fall. The market was expecting it to fall, so it's not as good as you think. What about the number of jobs? Pretty low. I mean, that was last month. Pretty low. 142. Last month was 114, but was revised down, I believe. All right, the July report was revised down. How much? 25,000. On your paper, you might want to talk about the previous 2 months because I think June was also revised down. So when you have 2 months, I think the two combined were down like 89,000 jobs. So June and July were both revised down. How does the market react to that? It's really interesting. I've seen reports that come out and the market really strongly reacts, and then the next month they do a revision that's, if the revision had been the original number, the market would have gone the opposite direction. But the market then ignores the revision, which doesn't make a lot of sense to me, but it's tough. The Fed's not trying to estimate number of job changes, they're trying to estimate number of jobs, which has error in it. And then the error goes in the change, and the error in the change is huge. The error in the number is not. So the market, I think, is a little fixated on a number that's pretty much on a guess. Payrolls did what? Private payrolls, excuse me. 118,000. Private payrolls is important to talk about. Mainly because, you know, that's government jobs. There was one time I remember, I think this might be during the 2008 crisis, I can't remember, but the jobs number looked terrible. But then discovered it was terrible because government jobs got cut. All these teachers are being laid off because of the crisis, and state governments are doing badly. Private payroll actually looked okay. So the market came back. Not that they don't care about government workers, but when it comes to the economy, the fact that you're laying off government workers, they tend to come back when the economy comes back pretty quickly. So what about this one? This one's a tough one. The answer is B, but that's not one you know off the top of your head. I'll show you a really good report you can use for that. The S&P 500, well, we know we don't use basis points with the S&P. We don't use basis points ever with the S&P. So either way, we don't say it fell 52 basis points. We don't say it fell 173 basis points. So did it fall 52 points or 95 points? 95, 1.73%. We know 1% is a pretty decent big day. So it was a pretty big day. The 10-year treasury, on 10-year treasury, no, we never use the percent for the change. Never. So you never want to talk about a percentage change in a percent. So the question, did the yields rise or did they fall?
Yields. Wait, what?
The yields rise.
Yields fell.
Yields fell. So prices did what? Rose slightly, not a bunch, but a little bit. Participation rate's been pretty important. That's one you could put a longer term graph in to show that we're still well below pre-COVID levels. What did it do? It remained the same, didn't it? Now, this last quote, I was trying to find a Jerome Powell quote, but he didn't say anything on Friday. I found the quote, and then I thought, wow, that's a great quote. And then I discovered it was from 2 weeks ago. So which of these is obviously wrong? Is the Fed talking about further tightening?
No.
That one you can kick out. Remain tight labor market is gradually cooling. That's something they may have said 3 months ago, but probably not this last month. He wouldn't have said this last Friday because, or any of them, because obviously the focus last Friday was on employment. So he didn't say this, but one of the Fed governors said this: the balance of risk has shifted. The quote I found from Jerome that was from 2 weeks ago is almost exactly this quote. So he almost did say this, but not here recently. Because remember, in August, the stock market sold off as well for the exact same reason, the jobs report and the Bank of Japan. So we've had 2 jobs reports in a row where the stock market has just crashed, and then it comes back. So it came back strong yesterday. It's coming back okay today. It lost 1.73%. On Friday, it's up about 1.5% since then. So does that mean it ignores it? Should you buy on these dips from jobs reports? You would have done great if you did that early August, but if you look at number 5, you might say, well, duh, they added education jobs in August because school's coming back, but you have to always be careful which ratios are seasonally adjusted, which aren't. I'm pretty sure that the jobs number is seasonally adjusted. So it doesn't bump in August for teachers because they're already assuming teachers are in the numbers. So you have to be careful. If it's seasonally adjusted numbers, and sometimes they're annualized numbers, so you have to just be careful on that. So let's look at the jobs report. So I really like this first chart. This first chart gives you most of all the numbers that you need. And you can get that if you look at the paper description, that very first link I give you, and you look on their calendar, they give you this. This is the most common one you see. I don't know who's the official one that creates this, but here you see the prior and the revised, down 25,000, the consensus, the range. You could talk about the range. The range can be important if you're outside of the range. So you might say we missed consensus, although it was in the consensus range. The range was really wide this time. So you were within the range. The unemployment rate fell. And you can see the range on that was pretty wide as well. That's a pretty wide range for unemployment rate, but came in right on consensus. Private payrolls missed by 16,000. The total missed by 18,000. Why did it have manufacturing there? I don't know. We'll talk about it. You can look at all of them. Participation rate stayed constant. And then on these, I didn't see a lot of talking about these. That 3.8, you might say, well, that's well above the 2%, but these are earnings. Earnings tend to grow faster than inflation because of productivity. So it's okay for earnings grow 3% as long as we have productivity, because then inflation only be 2%. So you can't get too worked up about that number. I have never heard anyone that worked up about this number. Average work hours, I haven't heard a lot of discussion on that. You can talk about it in your paper. It's there. You don't usually get a lot there. If you're going to talk about ISM in your paper, make sure you set it up. I will count off this time if you just start talking about ISM. So if you're going to talk about ISM, are the job openings, which is a good one to talk about as well. The ISM manufacturing, ISM services came out really, really strong. Durable goods came out okay. Industrial, there's several things you can talk about, but your boss only asks you to talk about jobs reports. So if I were doing anything else outside of jobs report, I would start it off with something along the lines that put the jobs report in a greater context. Or while the jobs report came on Friday, we did get some other economic indicators early in the week that weren't quite as negative, something like that. So your boss knows, why are you putting ISM in there? I can tell who's copying the papers from the examples, because I hate how the examples do ISM. They have it just, they throw it in the middle of the stock market discussion, which makes no sense. So if you're going to talk about ISM, I put it right after you talk about the jobs report as just another economic indicator. I wouldn't go talk about the jobs report, then talk about the stock market, then talk about the ISM. But a lot of students do that because that's what the example papers do. So ISM, supposedly, if it's below 50, that means the economy is slowing down. But the official number is above 50 is good. Between 43 and 50 just means slow growth, and below 43 means recession. The ISM is a really good indicator of recession. It's actually in the leading economic indicators. It's one of those. So it's a pretty, and the reason it's a good forecast is because it is a forecast. It's not asking what happened in the past. It's asking these people, what do you expect over the next 6 months? So that's why it's a good forecast. So y'all probably in your economics class, you learned the difference between leading, coincident, and lagging indicators. Y'all remember that? So the leading economic indicators is a leading indicator. What about the yield curve? Is that a leading indicator, coincident, or lagging? It's a leading. Yeah, it's a good 12 months out. What about the jobs report? It's a lagging indicator. It's telling us stuff that's way in the past. Because employers, being in recession, they don't fire people immediately. It usually takes them a little bit of time. And they start firing people, the employment starts getting worse. And then once you see that, you're probably coming out of a recession. So it's a lagging indicator. So that's why some people are saying we enter recession in March, because we're already seeing the aftermath of that. So, all right. And then down here, I brought the CME group. You can see the jobs report increased the probability of 25 basis points cut and reduced the probability of 50. So essentially the market looked at it and said it was bad, but it wasn't horrific. The Fed's going to cut 25. So there's a 70% chance they'll cut 25. There's a 30% chance they'll cut 50. We get a number tomorrow that's important. You may remember that. It's tomorrow, CPI, and then Thursday, PPI. So we get two inflation numbers. What if they come out higher than expected? That could impact this as well. So, Trump and Harris are watching these numbers. What Trump's going to say if they cut 50, he's going to say, oh, the Fed's on the side, even though he nominated Jerome Powell, the Fed's on the side of Democrats. Harris is going to hope they cut 50. But will that be enough to do anything before the election? That takes them 6 months, so who knows? But when you're a politician, you say whatever you want to say, especially today, people love it when they talk about how government's, evil and they're against us. That works on both sides of the aisle. But the market is looking at it from a very economic, what makes sense for the Fed. So 25 cut is probably the most likely. We'll see, when does the Fed meet? 17th, 18th. So it's a couple weeks. So I guess next week, right? So we'll find out next week what happens. Jerome Powell, they're essentially signaling that they're going to cut 25. And if they're going to cut 50, they would probably say something to help the market. They tend to like the market to be right. You notice that with Greenspan, y'all don't remember Greenspan. He was quite a long time ago. Greenspan's very, very interesting. Anybody remember, or you may know who Greenspan was married to? Have you ever heard of Andrea Mitchell? So y'all are too young. So anyway, Greenspan was married to a very famous news reporter. Can you imagine you're the Fed and you can't leak out this inside information? You're married to a reporter. I mean, a really famous news person. So I don't know if he talked in his sleep. If he did, I'm sure he was taking notes. But it was really interesting. I mean, he's married to this really, really famous person. But Greenspan was famous for saying stuff that made no sense. He was like as unclear as he possibly could be. Then Bernanke come in. Bernanke's like, we're going to be much clearer. We're going to make sure the market knows exactly. Yellen was the same way. Jerome Powell's the same way. So we went from Greenspan, which is, have you heard the term Fed speak? So that's prior to your time. Fed speak is Greenspan. Let's say stuff so no one knows what we're doing. So with Bernanke, Yellen, and Powell, it's the exact opposite. We want the market, and especially Bernanke, we want the market to know exactly what we're doing. We don't want them being surprised. We want them to know. So that's where we are today. And so if the Fed was going to cut 50 and they could see that the market is expecting 25, they might say something because they come out and Powell says, I'm not sure the market understands the weakness of this job report, something to hint that we might do 50. Could you put these charts in your paper? You could. This one has a lot of extra information you don't need. The ISM, the most important ISM is really the, I just forgot the name of it, the new orders. That one was really weak. New orders is really indicator of what's going to happen next 6 months. And that one was particularly weak in the jobs report. You could put this into your paper, or you could just talk about it in words. The market interpreted this as the Fed's most likely to cut 25. You definitely have to have a paragraph in the paper one about the Fed. That would be really strange if you didn't talk about the Fed, because that's what everybody's talking about. Any comments on this? So this is a really good report. So I would encourage you, so you got that link in the paper one description. Start going to that website the first Friday of every month and just looking for that chart, print it out or something so you have it in front of you. Especially if you have an interview around that time, so you can look down in your palm, maybe write it in your palm. You can answer questions very specifically. So this is what the Department of Labor provides. So we added 142,000 jobs. You could put this into your paper. I love this. They do the prior 12-month average. So you can see what's particularly weak or strong. But I gave you this link down here if you want to just copy it. So you don't want to overwhelm your boss, but I were in my first job and I was doing this paper, I would be going through this and looking for some gem that no one's talking about that you think is really important. Find something in here. So this is the Department of Labor. Just shows you all, I mean, there's the historical data. They put the annual average, which is interesting. You know, these are some good charts that you could use. Here's what I just showed you, but there's a lot of other ones. So this thing goes on for, I don't know how many pages. There's no page numbers, so I can't tell you. 18 pages. What you don't want to do is just stick one of these bunch of these charts in your paper just to have more data. You think your boss wants that? Oh, you gave me 20 pages and I really just needed 4 or 5. That's not going to be good. But what you're looking for is something that no one else is talking about. You say, wow, I just discovered that adds value to your boss.
What's the title of this page?
Well, it's linked in the PowerPoint. So this PowerPoint's out there under paper 1, and it's linked there at the bottom. So it's the BLS.gov web. I don't know what MSIT means. SES highlights.pdf, but it's there. And in fact, that link, if you use that link, it updates automatically every month. So you don't have to have a link for each month. You use that link, it'd be the same link for the September report. You get all the data. So it's a good one to use. I do tend to see this chart a lot in papers in the papers students write. So find some insight no one else is talking about. That's why you read articles. You're looking for people like Bill Gross. Bill Gross is the big bond guy. He's obviously talking about interest rates, very interested in interest rates. What is he saying? Find people that are, you know, this is their business, some insights. Western Asset, which is struggling right now. They have an economist, a chief economist. I love listening to that guy. He has some of the greatest insights. He's one of the best economists out there. You're looking for someone who has something to say that no one else is seeing, no one else is understanding. That adds value to your job. How did the markets react? S&P down, Dow was down. Who cares about the Dow? NASDAQ especially was down, but small cap was down significantly. Oil was down, gold was down, and bonds were up. Bonds were the only thing that were up. Remember when stocks and bonds, I don't want to forget how much we talked about this. When stocks and bonds move together, it's the economy. When they move opposite, when they move together, it's inflation. That's the backwards. When they move together, everybody's worried about inflation. When they go opposite, it's the economy. So they're moving opposite here. So this wasn't an inflation indicator. This was a recession indicator. So stocks sold off, bonds rallied. Not a lot. Bonds didn't rally much. Where are bonds today? It is really amazing what the bond market is doing. 10-year is quickly approaching 3.5%. It wasn't that long ago, just a couple of years ago, they were quickly approaching 5%. I was lengthening out duration, going longer and longer duration. Why? Because interest rates were so high. So my bonds have really rallied because I lengthened out duration. They've rallied a bunch. We went from 5% to 3.5%, almost 3.5% in just about a year and a half. Pretty amazing bond rally in just a very, very short time. So that's pretty. I mean, you can see it in the charts. So you look at it coming down. Even just this year at 470, we've dropped how many basis points in about 5 months? 470 to 360. How many basis points is that? 470 to 370 would be 100, so 470 to 360. So you can go in an interview, say, hey, just since April, 10 years treasuries dropped 110 bips. You're going to sound a lot smarter than most undergraduate students. That is a good rally. You go back further than that, when you see interest rates approaching 5%, now they're back down to 3%. It looks like a huge rise, right? Because in 2020, they essentially went to 0. But we went from 0 to 5% really fast, and now they're going from 5% to 3.5% pretty fast. This is a huge bond market. I remember one year treasuries sold off like 20-something%. in the first 6 months of the year. If the stock market were to sell off 20% in 6 months, do you think people would notice it? But this bond market sold off 20% and no one was talking about it, other than bond people, because we just don't think about interest rates moving. So yeah, it's been a pretty spectacular bond market. So while bond market didn't move that much on Friday, it has been moving. It moved a lot last week and it's been moving even more this week. So we're dropping pretty fast. So you might want to emphasize that in your paper by doing a little bit longer term on the 10-year, just so how much the 10-year has rallied. You know, you might say, hey, it didn't max at 4.7 whatever in April, but we're already down to 3 point. You can't talk about 3.6 because that's today. You have to stop on Friday, but still down to 3.7. That's a pretty good rally. This chart was fairly intimidating. You're not seeing much up. AT&T, I used to own AT&T and I got tired of a stock that never moves, but it did finally move on Friday. McDonald's is up, who knows why. Chipotle, McDonald's, who knows why, foods, but essentially, you don't see a lot of bright rings, do you, other than AT&T? I think Tesla was up, wasn't it? Or Tesla has been up, it's one of the few. So what was the big part of the stock market that crashed last week? The biggest part, which industry? Those are there yesterday, we talked about it. What big former $3 trillion company is dragging everything down? Semiconductors down over 10% last week. So yeah, that one sector. Do you see that up there? Where are semiconductors? There's Nvidia, Broadcom down 10%. Broadcom beat on earnings, and they're down 10%. So Broadcom actually reported earnings, so they're down a bunch. Yeah, which one's Broadcom? Avco. Why do they call it Avco? You can read the history of Broadcom. It's an interesting history, but they used to be a different name company, and so they merged and they kept the ABGO. But yeah, all of what semiconductor did well last Friday. Texas Instruments did the best. They were down 2%. That's pretty fast. So could you bring that up? Well, that's just Friday. Did the job report cause semiconductor stocks to come down, or was there something else going on? It's probably something else. But you could certainly bring it up that especially semiconductors were really hit hard. Do you remember where I got this chart from? FinViz. Yeah, FinViz is a great site. I used to think Yahoo Finance was a good site. I don't like Yahoo Finance anymore because they're starting to charge money for everything. You used to be able to dump information from Yahoo Finance, can't do it anymore. I don't know how much their premium. Anyone have a Yahoo premium account? If it's $5 a month, maybe I would do it. But I have no idea. I have to look and see. You can get all the information, that same information from Bloomberg, but it's kind of nice when you don't have a Bloomberg account. Here's the FinViz that just shows everything. The very top one is VIX. So in your paper, you're trying to bring it, you have to do the S&P 500 in the 10-year, but you want to add 3 or 4 other things. The VIX might be a good one to add. The VIX jumped a bunch, as you would expect, on Friday. Natural gas was up. Who knows why that was. The Japanese yen continues to do pretty well at bouncing back. And then tech stocks are at the bottom. You see tech stocks a lot down at the bottom. A lot of things down. Now, commodities tend to be pretty volatile, so you somewhat expect them to be bouncing up and down. So why is palladium down 3%? Why is coffee down in one day? It's pretty volatile. But what do you notice? What color do you notice the most? A lot of red, right? So everything was down, right? Even gold was down. Gold you would have thought would have done well. So why does gold go up or down? Inflation, weak. It goes up if inflation goes up, if the dollar's weak, it goes up and interest rates fall, interest rates fell. So you would have thought gold would go up on Friday. Why did gold go down on Friday? I don't know. It didn't go down much, but it was strange that it went down. I wouldn't put this chart into your paper unless you just want to emphasize there was a lot of red on Friday. And here's the more detailed charts of the day. You can see the S&P didn't just drop when the report came out. It slowly dropped and then it stayed down. So the initial reaction to the jobs report wasn't as negative. It took them, until about 11 o'clock. So it took them about an hour and a half to figure out, they didn't like this jobs report. What are they looking at? Who knows? They may be reading that Department of Labor report. Or the Bureau of Labor Statistics, they're all part of the same thing. Dow Jones, they all look very, very similar. You know, who knows why that jumped up there. NASDAQ, small cap, they all just dropped. So S&P down 95 points. You can say down 94.99 points, but you're perfectly fine just saying 95 points or 1.73%. I wouldn't talk about the Dow if I were you. NASDAQ you might talk about, mainly because we're seeing such a big sell-off in tech. Russell's going to do poorly anytime you have recessionary problems. Small companies tend to do poorly. Crude oil, I don't know if I'd talk about crude oil. I don't know if that was a big deal on Friday. Crude oil, there's any kind of economic weakness is going to be down. I don't know if I would talk about gold necessarily. It wasn't a big day for gold. And gold really didn't move until the end of the day. So who knows what was going on. Then interest rates, you have to talk about that. But that's where you might put a longer term chart in there. And that's pretty easy to do. It gives you some good graphs of what's going on in the bond markets with the good rally this year so far, second half of this year. So you can use any of these charts. You can create your own charts, make them prettier. But I just want to make sure I capture it because things like FinViz, this chart, you can't get this chart after Friday as it goes away. So I wanted to capture some things before they went. Some of the others are like the Yahoo Finance charts. You can't get those day charts once you leave. If you want some better charts, a really good chart to use in Bloomberg is a GIP. The GIP chart allows you to do before and after market. So the GIP chart will show you the initial reaction to the market. So if you bring that up, you can do the S&P 500 and do GIP. And you just click after hours. That's what I usually look at. FinViz also does that, but you have to be there right when it happens. You can't go back and look at FinViz in prior days. So FinViz, in fact, I love FinViz when I'm at home right before the report comes out because FinViz is pre-market and it shows the immediate reaction. Yahoo Finance will show that to you until the market opens and then they don't show that anymore. Whereas Bloomberg, they'll show you the pre-market and the post-market. That's going to be important for your second paper when you're doing earnings reports because most firms report either before open or after close. So the first time you see the market's reaction is after close. It's that after hours trading. It's not during the market. So if you wait until the next morning when the market opens, you've had 12 hours for people to react. So that's not the initial reaction. And sometimes you'll see a really jagged line. Because the market reacts, and they're trying to figure out what did it say? Was it good news? What is it bad news? What is management saying? They're listening to the conference call. So you can get some good information if you react really quickly. If we look at before I get to talking about the paper, I did add another job opportunity out there. This one looks interesting. I'm going to try to get them to come on campus. I don't know Alta Capital. They've got a junior research analyst intern. So if you don't have an internship for next summer, there's someone. Has anyone ever heard of Fox? Alta, I don't even know what that means. That could mean, I don't know if that's a person's name. Maybe it's two people's names. So just looking at paper one, I put the PowerPoint out there. Let's look at a student example just to remind us. So you want to make it look like a journal paper, something but be publishable. A good abstract is not bad to do. The abstract, I kind of like it being italicized and centered, but however you think makes it look good. My title, I would probably, instead of just saying what the paper is about, I'd probably say what happened on Friday. So strong negative market reaction jobs report or something. For your boss, that's a little overkill, but for a paper you're going to publish, then talk about the employment report. Again, make sure you put the stuff together that goes together. Private payrolls goes with the jobs. Jobs goes with the wages and the hours, and then unemployment rate, the 4.2% goes with the the participation rate. So make sure you combine the right things together. And then this makes no sense to me at all. They talk about the jobs report, then they talk about the stock market, and then for some reason, they stuck the ISM in there. Why did they do that? Because probably they saw an example paper from a previous semester that did that. So if you do that, I'll count off because it makes no sense to me at all. Your boss can be going, why are you talking about ISM all of a sudden? I don't understand. I mean, it's like you start talking about who won the preseason game between Dallas and whoever. It's like, wait, why are you talking about that? So be real clear. Don't write just to write. Be real clear. Think about your boss has got this report, about to go meet with the CEO, and then suddenly like, why are you talking about the ISM? I didn't ask for that. That's kind of strange. So you got to set it up, put it in the right spot. It doesn't belong right after you talk about the stock market. It belongs, you're trying to give more context to this jobs report. Put it right next to the jobs report. So where do you get your charts? This looks like he or she made their own chart. The problem with this one is it goes after the jobs report. So you don't know these days exist because you're writing it on Friday. So that's not good, but you can make your own charts. You can do Bloomberg charts. That's perfectly fine. They're not pretty, but for Bloomberg, that's okay. Because having a Bloomberg chart in your paper looks impressive on LinkedIn. So, kind of pretty up as much as you can, but you're gonna have trouble kind of controlling the colors and the layout, but Bloomberg is okay. You can stick a Bloomberg chart in there. Now, you were talking about Friday. Make sure you talk about Friday. All right. Some students get really confused. They talk about the stock market for August or whatever. You want to talk about what did the stock market do on Friday? If you want to also say what has it done year to date, a year to date chart right now, I think it'd be great because what you're going to see, I would put 2 arrows and say July jobs report, August job report. I would want my boss to see the last 2 job reports the stock market has sold off. I think that would be insightful. I might even point out the previous job reports. And we've now had 2 job reports in a row that the stock market hated. What does that mean for the next one? That's pretty important. So find ways to educate the boss on stuff that you figured out that they won't have time to figure out. And then they talked about other things like Dow Jones and other things. Find things that are interesting. I'd probably talk about NASDAQ, just given what tech stocks have done. I might talk a little bit about semiconductors, which probably has nothing to do with the jobs report. So there is some noise being created by what's going on in semiconductors. Probably talk a little bit about small cap, just because the fact that they sold off so much just means the stock market is worried about a recession. Those are kind of things that I would do. Could you throw other things in there? Well, we're getting the CPI report today, which means the last CPI report is pretty old, but you could definitely do that, or you could do this PCE index if you think that would be insightful. I might talk about the leading economic indicators, given that they've been negative now for about 4 or 5 months. So the leading economic indicators has been screaming recession for quite some time. It just hasn't happened yet. I might talk about the inverted yield curve when I'm talking about treasuries. That would not be a bad one to do. The yield curve has gotten more inverted because the 10-year has dropped so much. So it's more inverted today than it was a few weeks ago. I mean, if the 10-year has dropped 110 basis points, but the Fed hasn't done anything on the short end, the yield curve is definitely more inverted. That might tell you something. So, but what do you put in your paper? That's what you got to decide. You got to use, I've told you things you have to put in your paper, but there's things that you can do, and they're going to change every single report. So, all right, so we're going to leave this report unless anybody has any questions. If you're not a writer, scared of writing, then I would set up time with me by Zoom or come down to the Finance Study Center and sit down with me, and we'll go to it and we'll look at it. I'll look at it and make sure you have all the components. And also look at your writing style. If you're not a good writer, you need to become a good writer. Take a technical writing class here at UTSA, improve your writing skills. One thing that really helps is to read your paper out loud. Or if your mom's like a journalist, have her read it out loud to you. Have your 6-year-old nephew read it out loud to you. Find people that is like, wow, that's really stupid. I don't know, someone who's going to be really honest with you, because you got to become a good writer. want to work on that writing skill. My writing skill was all my first boss in finance. He had a degree in English. He was actually my boss's boss. That guy could write so incredibly well. I was scared to go into his office. I'd hand him a 3-page paper. He'd rip it to shreds. He would take 3 pages and convert it to 2 paragraphs, and he would say more in 2 paragraphs than I said in 3 pages. And I slowly started. That was my boss's boss. Now my boss couldn't write for anything. He would write a 3-page memo to invite people to a meeting. It's crazy, but his boss could write so well. He edited textbooks, really good writer, had a PhD in economics, smart guy. So I started listening to him about how to write more clearly, and I learned as much as I could from him. So you got to become a good writer because we do write a lot in finance. All right, so that's it for paper 1. Y'all got it? Y'all ready?
What's the paper do?
Whatever the syllabus says, I can't remember. So look in the syllabus, it's in there. If you've got some time, I mean, in practice, you'll have about an hour. I've given you like 30 days or something, so you got plenty of time. I'd write it this weekend, get it out of the way, and then come talk to me and start working on it. Talk to each other. You can read, it's not a group project, but you can certainly read your papers to each other, criticize your papers, read your paper out loud. There's students who are really bad at incomplete sentences, run-on sentences, taking 6 sentences to say something they could say in 1 sentence. I see a lot of that. So, be real careful in the writing style.
Should we wait to write about CPI data? Or?
Well, you can't put it in this paper, but if you want to practice looking ahead, yeah, you can certainly. So I would definitely be looking at the report tomorrow for CPI. That would be an important one. Probably more so. PPI is so volatile, it kind of gets ignored because it can drop and rise for other reasons. But yeah, CPI is probably going to be pretty important. CPI is really important. I showed y'all it's not as good of a measure of inflation, but it does go right into stuff. So it goes into tips, goes into Social Security. It's used as the official number. So the fact that we think it's somewhat inflated inflation, it's an important number because it does feed through. It does feed through Social Security. So it's an important number. All right. All right, let's continue. We don't have as much time here left, but let's talk. Can anybody tell me what DC cuts I means? Duration. Okay, so duration is what? The weighted average time to maturity using what's it, your weights? The discounted cash flows. All right. How many subcategories are there?
6.
Subcategories of duration.
Oh,
3. Short term,
Intermediate.
intermediate, long term. And your strategy is what? You expect rates to rise. What do you do with duration? Shorten duration, expect rates to fall. Lengthen, shorten duration, lengthen duration. All right, what's the next letter?
Convexity.
Convexity, the next letter.
Credit.
Credit, the U.
US.
Non-US bonds. The T.
Tax.
Taxes. T is not for Texas, it's for taxes. What's the S? That's the one a lot of students make up a whole new word on the exam. So S is about 50% of Frank Farbosi's book on fixed income. It's massive structure. Yeah, we're going to talk some about structure on the convexity, and then the I, not interest, inflation. Right, inflation. All right, it's a great list. If I can add anything to it, I would, but it's a great list. So we did duration somewhat last week. Duration is the weighted average time. I'll actually show you mathematically duration. It's a really easy number to calculate using stuff you did in 13. Just the normal pricing of bonds. It's really straightforward. If you want to learn, duration is an important concept. I don't know if any of y'all are going to take John Tui's fixed income class. But if you go onto Wikipedia, they do a pretty good job. Wikipedia is asking for money again. They do a very good job. So I don't know who writes Wikipedia posts. I remember some quarterback in St. Louis, can't remember his name, but he set some record. And I thought So I immediately clicked on Wikipedia. I want to see how quickly it was updated. And it was updated before I got into it. So I don't know. There's people must be already have it written. In the second he does that pass, they're hitting. So, but I don't know who these people are. It must be finance professors, but they're written very, very well. And even more, their links are really, really good. So they mentioned Macaulay duration and modified duration. I think they should just call it Macaulay duration because all the difference is they had to make one correction to Macaulay's formula, and that's what modified is. They should have just given them credit for it. But the modified and Macaulay are essentially the same thing. So you can read all about it. They show it to you, and they give you the formula, and you'll recognize the formula. It's a very, very simple formula. So y'all recognize this. So the sum of n starting from 1, the present value. So what is that? That's the price of the bond. What's the price of the bond? It's the present value of all the coupons and the principal. We'll see that. We'll do it in Excel so you can see all the steps. It's a really simple formula. You can do that in your financial calculators. And the numerator is exactly the same with just one addition. What's the only difference between the numerator and denominator? Time. That's all duration is. So time to maturity, you got a cash flow in 6 months. So 0.5, you got a cash flow in a year, 1. You're going to multiply that time times the present value of that cash flow divided by the present value of all the cash flows. That's all duration is. It's a really simple concept. So we'll look at that and see. There are other durations that get really, really complicated. You can see modified duration is essentially Macaulay duration, but they make an adjustment for the yield. T-rate duration. The only place I've seen that is life insurance companies, but that's where you get really, really precise with your duration. There are other ones. I don't think they have. There's effective duration. There's some others that you will see in there. Notice this word right here. So effective duration. And there's also, does that word look familiar? Convexity. There's a close link between duration and convexity. So Wikipedia talks about duration and then you go into convexity. And one thing you notice if you click on convexity is you're going to start looking at discussions about Black-Scholes. What does Black-Scholes do? Option pricing. What does convexity have to do with optionalities? So there's a lot here. So who is taking John Tui's class? If you don't have it planning to take it next semester, his fixed income class. I highly recommend it. He's a life actuary, so he knows this stuff better than anybody. Yeah, this really, really crucial. So fixed income has a lot of mathematics behind it, a lot of quantitative, a lot of stuff you can do, but the math gets pretty wicked pretty fast. This is really complicated stuff. You can actually use option pricing equations. So it gets rough, no question. So duration is a measure of price risk. How sensitive is a bond's price to changes in interest rates? Short-term bonds have very little sensitivity. Long-term bonds have high sensitivity. Short-term bonds have low duration. Long-term bonds have high duration. The higher duration, if your duration is 2, you're not very exposed to interest rate changes. The interest rate is 10, you have very high exposure to changes in interest rates. And here's the formula you should know. Every finance major should know this formula. How much is that bond price going to change? This is an estimate, but it's going to be minus the bond's duration times how much interest rates change. Really, really famous formula in finance. Works really, really well if interest rates don't change much. If they change plus or minus 1% or 100 basis points, you'll get pretty close with this formula. Beyond that, this formula can really, really be wrong. You can get wrong pretty badly because of convexity. So I gave some examples here. You can read through those. We did some of those last class. So generally the yield curve is upward sloping. Longer term rates are higher than shorter term rates. That's not always the case, but that is the case. And part of that is what people say is a risk premium, because longer term bonds are riskier. They're more sensitive to interest rates. They should pay you more to compensate you for that risk. So in money and banking or economics, you should have you should have heard the three theories about why the yield curve is shaped like it is. There's the expectation theory, you have the risk theory, you have the liquidity theory. I don't know if y'all remember those pretty important theories. So one of them is the expectation theory. The reason long-term rates are higher than short-term rates is we expect interest rates to rise. That doesn't make sense because the yield curve is usually upward sloping. We don't always expect rates to rise. But the risk premium is the other one, is longer term bonds are riskier, so they should pay more. And then the liquidity preference is just, where do people prefer these bonds because banks and insurance companies like them have longer term bonds to match up their liability. But those are those theories. This website does give you some history. So if you want to go back, like in 2019, you can get interest rates historically and just compare when did we have an inverted yield curve. Yield curve did go inverted somewhere in late 2019. Amazingly, see here the short-term rate 218 versus 180 for the long-term rate. So you can go back and look. There was a website they used to have, and they took it down. It's probably out there somewhere where they actually have the graph itself, and that's far more interesting to do. So if I were you, I would bring in all of these rates and just get a historical context of where they've been. How high did they get in the 70s? When did yield curve invert coming out of the 70s, where we're expecting interest rates to come down? There's a lot of history there. Pretty interesting stuff. All right, we already talked about the asset allocation. Use the word shorten and lengthen. That makes more sense. So, if you're in an interview this Friday and they ask you strategy, you say, well, my bond portfolio, the obvious strategy would be the shortened duration because the lengthened duration, expecting the Fed to cut rates. But the 10-year is already down 110 basis points, 110 bips since April. So maybe the bond market's already reacted. So now the question is, how much further down can it go? And that's going to be a tug of war between inflation and the jobs. There's a lot of things you can say that's going to sound a lot more sophisticated than typical undergraduate student. So I think, Tristan, that was your point. Start looking at stuff, writing about it, even if it's not a paper for your class. So you start getting into the lingo of these things. Could you make an argument that now is the time to shorten duration? So, inflation really hasn't come down much in the last few months. We got a lot of government spending. We got an election. We got two politicians, both of whom are saying things that are inflationary. I think this is a blip. I think the Fed's going to have to tighten inflation. You could say that. They may not agree with you, but it'd be a sophisticated answer. What you can say is, boy, I think the Fed's going to tighten, rates going to rise. I'd be lengthening the duration right now. That would be a really bad answer. All right. So there are wrong answers. There's opinions, which can be right or wrong, but there are wrong answers. You never want to lengthen duration. You'd expect interest rates to rise. Which means when you go into an interview, you better have an opinion on what you think is going to happen. Even if you don't have an opinion, go steal somebody else's and talk that. Go read Bill Gross, go read whoever at Cliff Hastings and see what they're saying. You might want to give them credit. That's even more impressive. Like, yeah, I'm just getting into this. I don't quite understand it, but I saw Bill Gross this week saying you got them captured then. That's a very sophisticated answer. But how are you gonna be able to say what Bill Gross said? You don't read the Wall Street Journal and the Economist, those kind of things, or go find Bill Gross. I don't know what he's saying now. He's a weird guy. He got sued by his neighbor for playing the Gilligan's Island theme song really loud because he got mad at his neighbor. So he's a little bit quirky, but he is Mr. Bond King, and I actually have his book with his autograph in it. He wrote a book on fixed income. I don't recommend it, but he is well known for fixed income. All right, you're all ready for convexity? My word, we got a few minutes here to talk about convexity. So we could spend the next 12 months on convexity. This is a very advanced part of finance. You're not supposed to have this undergraduates, but you can handle it. We're going to just scratch the surface. If you take John's class, I'm not sure how much he gets. I think he spends more time on credit, but he could talk about it forever. It's an important concept. So bonds do move up and down with interest rates, but not in a straight line, like duration says. That minus duration times some change of yield, that formula is a straight line. Bonds don't actually do that. Bonds typically are convex. When rates rise, they fall, but not as much as duration says. And when rates fall, they rise, but they rise more than duration says, which is great. That's what you want. So convexity is that second order change in bond prices due to the change in interest rates. And I may have given y'all the formula in the notes. Let's see if I put it in the notes. I can't remember. No, I didn't put it in the notes. I'll have to give y'all the formula. So what you'll notice with the formula for convexity is you add convexity on top of the duration formula. So minus duration times the change in yield, and then you add, oh man, see if I can get it right. So you take 2 times convexity times yield squared. I can't remember, but I'll show you that formula. Everybody knows the duration formula, the convexity one, you always have to look up. But what you'll find in the convexity part of the formula, so on duration, you take minus duration times some change in yield. On convexity, it's convexity, but you're multiplying by the square of the change in yield. And so when you square a small number, it gets really, really small. So convexity doesn't have much impact unless interest rates change a bunch. So that's the most important thing with convexity. It's a bigger number than duration, but you're multiplying it by a much, much, much smaller number. So it's that second order. You add those two together and you'll get them. So I showed y'all this last class, the thing my student created. So we'll do a 30-year bond, 6% coupon, no yield. So the coupon doesn't matter. And so, I'm sorry, the yield, let's make the yield, I did that backwards. Make the yield 4%. So this $1,000 bond you can buy today for $304. So you buy it today for $304, a zero coupon. So it doesn't pay any interest, but in 30 years you get $1,000. So what would your return be? Your return will be 4%. So you buy it for $300 today, it matures at $1,000 in 30 years, you'll make 4% a year. Its duration is not 30 years, but pretty close. It's 29.41 years, pretty close. And its convexity, that really, really tough number, is 904. 904 watt, I don't know. 904 units of convexity. All right. And when you look at the graph, you'll see convexity right away. This blue line is how that bond price would move if that minus duration times change in yield is the only thing that matters. So duration is a straight line. The green line is both duration and convexity competitive. The green line is how the bond price actually moves. And how often does convexity help you versus duration? Most of the time, some of the time, or all of the time. You're always happier, aren't you, with convexity? We love convexity. So we call this, when you see the green line is always above the black line or blue line, we call that positive convexity. Most bonds, treasuries, corporate bonds, most bonds have positive convexity, but not all. But that bond has a lot of positive convexity, right? If all you use is duration to guess that price of the bond, when interest rates fall 400 basis points, you'd be way off on your estimate, way, way, way off. If interest rates only move 100 basis points, you'd be pretty close with a duration estimate. All right, so if interest rates aren't moving, this is really critical. If interest rates aren't moving much, convexity is not all that important. So let me say this another way. Convexity is especially important when interest rates are volatile. You'll see that on the exam on the second question. When interest rates are volatile, convexity becomes incredibly important. Do you want positive convexity when interest rates are volatile or negative convexity when interest rates are volatile? Well, if convexity helps you and positive convexity is what you want, then if you think rates are going to be volatile, you want positive convexity. We'll talk more about that. All right, this is a great website. I still haven't emailed them. I should email them and thank them for doing that again. If I did the wrong one. Nope, still the wrong one. All right, so let's introduce this. If you read ahead on the notes, corporate bonds, treasuries of Donald Trump, when he was president, he said something that freaked the markets out. He talked about paying off all the U.S. debt at par. Because he said, hey, interest rates are 0.5%. Let's just pay off all the US government debt. Can he do that? You bought a treasury, you bought it for $1,000. It's now worth $1,200. And President Trump says, "Oh, I'll just give you $1,000 for it. You think that would work?" That'd be horrible. So the stock market, the bond market actually kind of freaked out there for a few minutes. Can't do that. If you got a treasury bond worth $1,200, what's the government have to pay you? We got to pay you $1,200, right? So you can't pay off bonds. So there is no optionality to treasuries. The government has to pay you either the market price or they got to pay you when it matures. They can't, if they pay it off early, you got to pay it at the market price. But there are bonds that the holder of the bond, the person who borrowed the money is allowed to pay off the debt early at par. You may know a kind of bond like that. So if you have a mortgage on your house, can you pay it off early at par? Absolutely. Mortgages is the best example of that. So you got a mortgage that you borrowed money at 8%, and now interest rates are 4%. That person you loaned money to is really happy, right? You're paying 8% and the market's only 4% today. What can you do? You can pay that entire mortgage off at par. You don't have to pay them $1,200, you only have to pay them $1,000. And you can do that anytime. Would you do that? You can refinance that mortgage at 4%. It's an 8% mortgage. Yeah, you're gonna do that. That optionality helps whom? The borrower or the lender? It helps the borrower. What does it do for the lender? Misery. They hate it. It kills them. So there are some bonds that have what we call embedded options. If you go back to Wikipedia and you search on the word embedded, you probably find that in discussion on convexity. So there are bonds that provide options to the borrower. Treasuries don't, most corporates don't. There are callable corporates. Have you heard of callable corporates? So a callable corporate gives the corporation the right to pay off the bond early, maybe at a premium. They don't get to pay it off at par like the mortgage, but they get to pay it off at 102. But most bonds will look like treasuries and corporates. Most of them don't have optionality, so they have positive convexity. What happens to convexity when you have optionality? So this is where it gets really freaky. You noticed in Wikipedia, they had the Black-Scholes option formula in there. These bonds have options for the borrower. The borrower has the right to pay off the debt early at par. Even if interest rates fallen and that debt's now worth $1,200, they can pay off that debt for $1,000. Now it costs them some money, right? They got to do some really evil things like title insurance, which is a complete scam, but they still have to do that. They have to pay some points to the mortgage company. So they'll sit down and do the math. But if it's in your best interest to pay off the debt early at par, what are you going to do? You're going to pay it off early at par. You'd be stupid not to. So it's not in your best interest to lend money like that unless you get compensated for it. So we think of these type of bonds as just straight regular bonds without any optionality, and you're selling a call option to the borrower. And we'll talk about options later. This is so cool, man. This is like cool. When part 2 of the CFA exam, they had an entire convexity question. And I had the entire Black-Scholes formula memorized. I don't need anymore. I just wrote the entire formula on that question because it was a Jenny Mae question. I was so excited. But yeah, I got this question nailed. This is my question. But it's just an amazing thing. So think about that when you invest in a mortgage-backed security, you're buying a bond and you're selling call options. When you sell call options, you get a premium. And what are you hoping? That nothing much happens so you can keep that premium. All right, y'all know much about selling options. Which is more dangerous, buying options or selling options?
Fine.
Now think again.
Selling.
You buy an option, what's the worst you can do? You buy an option for $2, the most you can do is lose $2. If you sell an option and you receive $2, someone has the right to buy a stock from you for $100, and they gave you $2 for that, and that stock goes to $150. What just happened to you? They get to buy that stock for $100. What do you have to do? You have to go out and buy it. You have to buy for $150 so you can give them the stock for $100. How much can you lose? Infinity. Y'all like losing infinity? So when you sell options, you're on the hook. You have almost unlimited. So you think about a mortgage. How are we doing on time? Sounds like they're making leaving noises. We're like the most exciting part of finance there. Y'all probably want to stay the rest of the night, but I know you got to go. But when you're actually buying a bond and selling options, you're now in an entire new world of finance. These bonds were created in the late 70s and 80s. I'll tell you my story at USA because it's one of my biggest days at USA. I thought I was gonna get fired, but I'll tell you about it because I had the entire USA board. I was just a peon analyst. It's a pretty cool story. But I was trained on all of this on the CFA exam, but the people at USA buying these, they were trained in the 60s. They were doing some really dangerous things because they didn't understand these bonds. And we had this big battle. It was me, the peon versus the president of this company. I'll tell you that story because it's pretty interesting. Actually, reading textbooks is quite valuable. It put me 2 decades ahead of these guys just because I was reading current stuff. So we'll get into that. This is really, really cool stuff. So we'll get into it more next class. Read the notes, go to Wikipedia, read ahead. There's a lot of cool stuff on here. That's an important concept because that's what people are expecting you to know. But someone comes in and says, I just inherited $500,000. What should I do? They're coming to you. And first thing you gotta ask is, well, you want me to build your portfolio? That implies you don't want to spend the money now, you want to spend it in the future. So a portfolio is just investments that you're holding for some future purpose. Let's start off with, why are you investing? What's that future purpose? The key there is, do you need the money tomorrow or do you need it in 30 years? Like you do something different if it's in 30 years versus if it's tomorrow. What can you invest in? Your only asset classes are stocks and bonds. I'm going to show you an article today that, that may not be enough because of inflation. How many asset classes? We don't have too many, but we don't have enough so we can diversify your risk. Those kind of things you're walking them through to understand. They say, yeah, just stocks and bonds. Well, you want US stocks? You want big companies? You want small companies? You want companies that are doing really well right now that might be expensive, or you want some value stock? You're helping them understand that there's a lot of choices here. So we don't have 50 asset classes, but we probably need about 10 at least so that we can make sure we have a good mix. And how are you going to do it? You're going to hire someone to do it. You could go to Vanguard and do it all in Vanguard in one mutual fund. That makes it pretty simple. If you're going to do it yourself, but you're sitting and you come to me, then you're probably not going to do it yourself because you wouldn't be coming to me if you're going to do it yourself. But, you walk them through that. At the end of it, they should have a pretty good idea of what they go to Vanguard and invest in a target fund. Is that the best solution? Well, it's as good as any other that you can get without having to pay massive amounts of fees. When you pay the fees, they're going to do almost the same thing Vanguard does, but you get Vanguard without the fees. So, so is that a good? I don't tell people Vanguard is the best answer. I just know it's an answer that they're not going to be really mad about 30 years from now. Because who invests in the absolute best solution to everything? Who buys 50 stocks or the highest 50 returning stocks in the market? No one. No one's getting the best solutions. So a good solution. So I'm typically, hey, for most retail investors, I'm not the only one saying that. Charlie Ellis, Warren Buffett, Jack Bogle, there's a lot of people saying, hey, just go buy index funds, be well diversified. But you still have to walk them through those questions to make sure they know what they're doing. All right, let's spend a little more time on convexity. So this is a tough one. So let's talk about these unusual bonds. So a lot of bonds like treasuries, corporate bonds, there's no option from the borrower standpoint. They have to pay you off as scheduled. So if it's a 30-year bond, they're going to be paying you for 30 years. So if you buy a 10-year treasury, you're going to get money every 6 months from the government, and then at the very end, you'll get your principal back for 10 years. It's set. The government can't come. Now, the government can buy your bond from you, but they have to buy it at market value. They can't buy it back at par. So if you got a treasury bond that's priced at 1,200, government can't pay it off at par at 1,000. Corporate bonds are just the same way. So most bonds, the borrowers they're set. They have nothing they can do. But some bonds give the borrower the right to pay off before maturity at some set amount. So if it's a mortgage, they get to pay it off at par. So if they borrowed $300,000, they get to pay off $300,000. So if their interest rate's 8% and interest rates are now 4%, they get to pay that off at $300,000 and go out and borrow at 4%. So they essentially get to cut their interest rate from 8 to 4. So that's called prepayment. Prepay the loan before maturity. Callable bonds, those are corporate bonds. Corporate bonds allow you to pay off the bond early, but usually with some restrictions. So if Walmart borrows $500 million, and it's a callable bond, they probably have to pay it exactly as scheduled for 3 years. And after 3 years, they may be able, they have the right to pay off the bond, but maybe at 102. You have to pay a 2% penalty, and maybe it's a 1% penalty after that. That's a callable bond. We're not going to talk about those at all. Those do have optionality. There is a phrase you can certainly look up if you want to study this more, which is let's see how many of y'all heard of this. Y'all know YTM? Yield to maturity. What about YTW? Y'all know what YTW means?
Yield to weight.
Yield to, not yield the best, but
Worse.
yield the worst. It's a great term. And if you Wikipedia that, you'll find all kinds of really cool stuff. I don't know what Investors Wiki means, but Wikipedia, I don't know how to spell Wikipedia, so I didn't write the whole thing in. Maybe that's right. So yield to maturity is just if the bond pays exactly as scheduled. This is, it says the yield to maturity is the internal rate of return of a bond. What's that return that if you discounted all the cash flows, at that rate you would get today's price? That's yield to maturity. All right. But if a corporation has the right to pay off the bond early, say in 2 years, they're going to do that if that's going to save them money. So yield to worst is what's the worst case scenario for you as the investor that if they paid off early, that's what you would make. So maybe Walmart borrowed at 7% and they can't pay it off early for another 2 years, but in 2 years they can pay it off early. And right now interest rates are 4%. If interest rates stay at 4%, they're going to pay it off early and switch to that 4%. So what yield to worst does is it takes what is Walmart most likely to do given what interest rates are today, and what would be your yield in that case. That seem clear? So essentially they look at every scenario, what they pay off in 2 years, what they pay off in 3 years. So in 2 years they have to pay a 2% penalty, and 3 years they pay a 1% penalty, then they pay. And so the yield to worst is you do every scenario that Walmart can do. What's your worst yield? That's yield to worst. You notice it only applies to callable bonds. So treasuries, you can't pay off early. So treasury, the yield to maturity, yield to worst are the same thing because there is nothing you can do differently. So lowest yield of yield to maturity, given all the potential scenarios there are. Everything, you look at every single possible scenario. Oh, I shouldn't hit that button, sorry. So you as an investor, when you have these type of bonds with embedded options, you're buying the bond and you're getting an option, essentially you're selling an option to the borrower to allow them to do something. All right, this is where it gets really, really tricky because options are really quite complex securities. So option prices, we'll learn this later. If you buy an option prices go up when volatility goes up. So if you buy an option on Apple stock and suddenly its stock is really volatile, that option is going to go up in value. So have this in your notes. Optionality loves volatility. Volatility is a wonderful thing. Why? Because you have the option to do something. If things get really volatile, there's a good chance what you want to have happen is going to happen, and you're going to execute and have a really good deal. So if Apple stock's moving really fast, there's a good chance it's going to shoot up. You get to buy their stock cheap and make a fortune. All right. But be aware when you buy a bond with an embedded option, you're buying the bond and you're selling options. So if you're buying options, you love volatility. What do you think about optionality when you sell options? You hate it, right? If you buy something, you like for its price to go up. If you sell something, you don't want its price to go up. All right. So that's really, really important. Option prices rise when volatility of the underlying, in this case with bonds, the option is on interest rates. When interest rates become more volatile, that option becomes more valuable. you as the investor are being hurt by that, the borrower is being helped by that, because you sold the borrower an option to do something, and when things are volatile, it's really good. So if you have a mortgage at 8% and interest rates get really volatile, there's a good chance interest rates could drop to 4%. You could jump in, refinance, and then rates shoot back up, and you're set. You're really happy about that. The lender, the person who loaned you the money, they're pretty upset. You know, they loaned it to you at 8. Now you quickly jumped in and got it back down to 4, and now rates shoot back up to 8, and they're like, they're not going to get you to do anything now. So when you buy one of these optionality bonds, you're buying a bond, selling an option, and you hate volatile interest rates, right? Put that in your notes 20 times. These type of bonds, embedded options, they underperform when interest rates are volatile. They outperform when interest rates are stable. Write that in your notes about 20 times because it's a really, really tough part of the first exam. We're not going to cover convertible bonds. We already talked about callable bonds. So let's talk the most important one, which is mortgage-backed securities. So mortgage-backed security, basically what this is banks like Frost, Wells Fargo, JP Morgan, they loan money in mortgages. They may do 15-year, 30-year mortgages, but they don't want those assets. Those are horrible assets for banks. Banks are very, very funded, very, very short term. CDs, savings accounts, checking accounts, very short-term funding. They don't want a 30-year bond on their books. That's a horrible thing. But they loan money for mortgages. That's what they do. So they loan out money on mortgages, and they say, we don't want these mortgages. So they take all of their mortgages, they lump them together into a trust. That trust essentially buys those mortgages from JP Morgan. How do they buy the mortgages? They buy those mortgages from JP Morgan by borrowing money on the market. So they borrow money in the market, they buy those mortgages from JP Morgan, and then the way they pay that loan back is they tell the borrowers, hey, any cash that we get from the mortgages, we're just going to send it to you. That's how we'll pay you back. When people pay their interest on the mortgage, we'll send that to you. When they pay principal, we'll pay that to you. So that's essentially what it is. They set up these trusts. So it's a type of asset-backed security. If you haven't studied asset-backed securities, get into it. It's a huge part. When I showed you Fabozzi's book, asset-backed securities are probably 40–50% of that book. They're a huge part of finance, even though they're not that old. They're younger than I am, which may still sound like old, but they're half my age, so they haven't been around that long. So an asset-backed security is when banks take an asset like an auto loan, like a mortgage, like credit card loans, and they say, we don't want these on our books. So they lump them together, put them in a trust. That trust creates a security on the public markets that borrows against those assets. The banks have it off their books, and now the market has those assets. So mortgage-backed securities, auto loan, auto-backed, credit card, they're all in there. Mortgage-backed is the most important one because they're the most interest rate sensitive. Do y'all know anyone who's refinanced their auto loan because rates fell? Doesn't happen very often, doesn't it? It's kind of a hassle. So it's not very often, but you probably know a lot of people have refinanced their mortgages. Credit cards are completely different because credit card interest rates change every month. So they're a very, very different animal. So that's a mortgage-backed security. This is known as securitization. Securitization, what that means, you take something that's not a security, like a home mortgage loan, and you put it into a trust to create a security. So that's securitization. And there's a lot of this going on. It's pretty amazing. I still remember UTSA's CEO, Davis, he was doing a presentation. He's complaining about our bank just wasn't growing fast enough. And he showed our bank's asset growth, and it was strong. It wasn't as strong as he wanted. I'm thinking, but they securitized like over half their loans. If they didn't securitize the loans, they'd be one of the fastest growing banks, or not, if not the fastest, they would have been the fastest growing bank in the US. But they had all these loans, they were making massive loans, but they were selling them off in the market. So they came in as assets when they sold them off and the assets went away. So I think he was being a little bit too picky because the bank was actually growing too fast because they actually, during the 2007 time, they were loaning mortgages that they shouldn't have been loaning. They were really horrible loans. So they were actually growing too fast, but you didn't notice it in their assets because they were securitizing these things and selling them off. And back in 2007, 2008, people were talking about shadow banking. They're saying, we think banks are the ones making all these loans, they're the ones that originate them, but they're getting them off their books pretty fast. So it's really the capital markets that are funding all these. Have y'all heard of Fannie Mae, Freddie Mac, Ginnie Mae, all of these institutions that help facilitate these securitizations? They just have different levels of credit. Ginnie Mae is full faith and credit U.S. government, so there's no credit risk at all. Fannie Mae and Freddie Mac, we're not real sure if it's full faith or credit, but they're very high quality loans from the standpoint of credit, but they're extremely risky when it comes to interest rates. So they set up a trust. You know, you probably go out and just Google, how does securitization work, and just see what comes up. Maybe look for a YouTube. It's a really, really important part of finance, especially if you're going to interview with a big bank. I would definitely do that before you do the interview. If any of y'all interview with a bank, come to me. I can show you some things. You got to get the Basel Accords down. You definitely have to understand risk-weighted assets. There's certain things you just have to know as a finance person going into a bank interview. And this is one of those. What is securitization? You really don't understand that, because every bank, UTSA, it's massive. They're doing $15–20 billion worth of this stuff. Seems like quarterly, quite frequently. So asset-backed securities, or ABS, mortgage-backed securities, is a type of ABS, but related to mortgages.
You were saying that banks don't want these loans on their sheets or on the papers, and that's why they securitize. But why does the market buy like the securities after they're securitized? Like, why does the market want them?
Well, we'll talk about that. So they sound horrible, right? If interest rates are volatile, you lose. So how do you win when interest rates are? So if you're doing one of these loans, would you want to be paid for the risk that someone could pay off early? Would you want extra return for that? I certainly would. Because if let's say you loan someone at 8% on a mortgage, and interest rates shoot up to 12%, what are they going to do? Think they'll keep paying at 8? So you don't win. What if you loan to them at 8% and rates fall to 4%? What are they going to do? They're going to refinance. What do you think about that? That hurts you. So you're going to give someone an option that is either going to not help you or it's going to hurt you. You're either indifferent or it's going to hurt you. That sounds like I want some compensation for that. All right. So the Luke's question, these bonds pay a higher return to compensate you for that optionality. All right. So you get an extra spread, compensate you for that. Anybody know what that spread's called? Well, not quite. Well, what it's not called. So let me see if I can help you out here. Let's see if it's in here. Not in here. We'll find it. Have y'all heard of OAS? Not the Organization of American States, but the other OAS.
Option adjusted spread.
Yeah, that's it. Have y'all heard of option adjusted spread? That's something else you can research on Wikipedia. There's some really great terms. Investopedia, I think, has it wrong. Let's see if they've adjusted it. I read their definition and it was absolutely wrong. All right, so let's see if I've got some numbers in here to show you. All right, I'm not going to do that again. All right, let's say you have a mortgage-backed security that's paying 4.5%. Let's say it's a Ginnie Mae. So it's the same credit risk as the U.S. government's. It's paying 4.5%, and the Treasury is paying 4.25%. So the mortgage is paying an extra 25 basis points. All right, for the same credit quality. Buy the Ginnie Mae, of course, you get an extra 25 basis points. But the government is going to pay you 4.25 no matter what interest rates do. What's the Ginnie Mae going to do? If interest rates rise, you'll get 4.50. If interest rates fall, what happens? They're going to refinance and you're going to get your money back at the worst possible time when interest rates are low. All right. So you're getting extra 25. That at 25 bips, the reason I use that is the last time I saw a study on that is about what banks are charging you extra for giving you that option. When you borrow from a bank, they're actually going to charge you an extra 0.25% to give you the option to pay off the loan early. What if you don't want to do that? What if you go to Frost, you say, Frost, I want to do a 30-year mortgage, but I'm never going to prepay. They're not going to give you a lower rate because no one else is doing that. No one asked that question. They don't have the ability to do that. You have no choice but to pay for that option. An extra 25 basis points. Now, that's not always the case because if interest rates are volatile, they're going to charge you more for that option. All right. So if this bond did not have the option to pay off early, it would have charged 4.25. Instead, it's charging 4.50. So that's where you get. So I actually have here the treasury. Okay, let's see. I've got three numbers there. Let's bring them in. So the mortgage is paying 4.5. If it didn't have this option, it would have been 4.25, and the treasury is paying 4.10. So I actually four numbers. All right. Sorry, I confused that one point. So this may not be a Ginnie Mae. So it's paying 4.5. If it didn't give you the option, it paid 4.25. But if you bought the same quality treasury, 4.10, or bought the same duration treasury. So its spread is what? 40 basis points. 4.5 versus 4.1. It's paying 40 basis points over treasuries. That's what we call the spread. The spread is how much does it pay over the comparable treasury. So it's paying 4.5, comparable treasury is paying 4.1. All right. But if it didn't have the option, it would be paying 4.25. All right. So the question is, what is the option adjusted spread? And this will get really confusing. Investopedia is going to tell you that the OAS is 25, and that's absolutely wrong. So the option adjusted spread asks the question, what would the spread on this bond be if it didn't have the optionality? I just told you, didn't have optionality, it'd be paying 4.25. Treasuries are paying 4.10. So what's the OAS? It's going to be 15 bips. The 25 basis points is the extra spread you get by giving the guy the option to pay off early. And they're also getting another 15 basis points because this bond has some other risk associated with it. All right, it gets really tricky. Let's try this because y'all are looking at me like I have no clue what he just said the last 10 minutes. So say a mortgage-backed security that's paying 6.2%. You got a treasury that's paying 5.5%. Most mortgage backs are priced off the 10-year treasury, and most mortgages are priced off the 10-year treasury. Well, let's talk about that just a second, because that's pretty important. Which of these bonds is amortizing? And which one of it is non-amortizing? So another way to ask, what does the treasury pay you? When does the treasury pay you principal? At the very end. What do they do before they pay you principal? All they pay is interest. Okay, that's a non-amortizing loan. What's an amortizing loan do? What do you do on your mortgage? Do you pay principal and interest every 6 months, every month, right? An amortizing loan, you pay principal and interest as you go. All right. So the treasury pays principal at maturity. This pays interest and principal monthly. Right. So when we talk about duration, the way you have time to maturity, the treasury is going to have a longer duration because it only pays interest until year 10. The mortgage back is paying a lot more cash flow. It's paying principal interest every month. So a 30-year mortgage back might have an 18-year duration, whereas a 30-year treasury applies a 25-year duration. You know, so or even shorter. 30-year mortgage might have like a 14-year duration. So if you pay principal interest, it shortens the duration quite a bit. So we're probably going to be comparing a 30-year mortgage-backed security to a 10-year treasury. They have about the same duration. All right. So what is the spread on this bond? So the spread is 70 bips. All right. 6.2% minus 5.5. Anybody disagree with that? That is the case. That is the spread. So now the question is the option adjusted spread. Well, if I say this mortgage-backed security yield would have been 5.9% if no option provided, then the question is, what is the OAS?
30 bips, 40.
So is it 30 or 40? So it's paying an extra 30 basis points to give you the option. So the option adjusted spread say, how much would the spread be if we took that optionality out? So what's the yield if you take the optionality out? 5.9%. So what's the spread if you take the optionality out? 40. So the OAS is 40. All right. See how tricky it is? The last time I read Investopedia, they said the OAS was 30. I don't know who wrote Investopedia. I called my friends at Victory Capital. I was like, did I learn the CFA wrong? Because that doesn't make sense. So you can see it's confusing. Let's see if Investopedia has fixed their site yet.
Oh, I see.
Option adjusted spread is a measurement of the spread of fixed income security and the risk rate, the treasury risk rate, which is then adjusted taking account embedded options. That doesn't tell you anything, which is then adjusted. What does that even mean? Typically, an analyst uses treasury yields. The option spread is the difference in yield between a bond with an embedded option, such as MBS, with the yield on treasuries. That's not true. This is the total spread, right? So if you go back to this one, what's the yield of the bond with an embedded option? It's 6.2%. What's the treasury yield? 550. So the spread's 70. That's not the OAS, that's the spread. All right. So I Investopedia, a tour wrote it, just was embedded options provisions included. Yeah, the Investopedia actually never even gives you a definition. They come and play it. When we say that, we didn't say it was the answer. We just said that's how you calculate it or you don't. They never give you the answer. All right. So pretty tough. If you let Wikipedia answer it, see if they do any better. I don't think theirs is actually even better. OAS is yield spread, which has to be added to a benchmark yield curve to discount a securities payment to match its market price using a dynamic model that accounts for embedded options. They still haven't told you anything, have they? So it's so convoluted, and I don't know why it's so convoluted. OAS is hence model dependent. What they're saying here is what's going to happen with your spread depends on what interest rates do. So the only way to figure out these bonds is to run a bunch of simulations. Are interest rates rising? Are they falling? Do they rise and then fall? They fall and then rise. You know, that all comes into the equation. And so actually to price these bonds, you have to run like 250 simulations. And then the price, I mean, you won't believe this, but it's true. You run 250, it's really a little bit more than that, but you run 250 simulations and the price of the bond is that present value, those 250, average of the present value of those 250 simulations. These bonds are very hard to price. They're quite complex. They take a lot of time to price. So what is this right here? In the context of MBS, what are you talking about there? Mortgage-backed security. The embedded option relates primarily to borrower's right to early prepayment. Yeah, I don't think they're defining the term. All right, let me give you one more chance here. Luke, I'll let you answer first here. So say the MBS is paying 5.2%. The Treasury's paying 4.3%. Without option, it'd be 5%. So what is the spread and what is the OAS? So spread 90. What's the OAS? Someone said 70. Did you say 70? Yes, 70 sounds right? Yeah. How much more are you getting because you gave them that option? An extra 20 bips. So you're getting 20 bips because you gave them the option, but then you're also getting another 70 bips for what? Credit risk, who knows what. The lady who ran our Ginnie Mae fund, Dee, I wish I could get Dee to come talk to us. Brilliant PhD in math. You need a PhD in math to run these funds. They're really quite complex. But I would put a catatonic. I say, Dee, why did Ginnie Mae's have an OAS? Because Ginnie Mae's have no credit risks. They should be the same risk as treasuries, and yet they have an OAS. If OAS is covering you for credit risks, it should be 0. That entire spread should just be covering you for the option. And she couldn't answer, as smart as she was, she couldn't answer that question. My theory is Jenny Mae's have an OAS because the models we're using to figure all this out are so uncertain and there's so much unreliable work. It's kind of like model risk. You're getting paid for the uncertainty of the model itself. But complex stuff, you don't need that for the exam, fortunately for you, but it is an important concept. So you can look up things like yield to worst, option adjusted spread, and you'll find mortgage-backed securities frequently in the discussion. You'll find convexity frequently in the discussion. So these are also known as pass-through securities because when the bank puts all these loans into the trust, all the trust does is just passes the cash flow zone to the lenders who are bought those securities. So if you buy a mortgage-backed security, all the trust is going to do is say every time someone makes a payment on a mortgage, that just goes out to you. And it just passes through. People making a lot of prepayments, you're going to get a lot of cash. People are making prepayments, they're actually sending their loans. Maybe they were listening to Susie Orman and they're paying an extra $200 a month on their mortgage. But now their mortgage rate looks really, really good and they can make more money buying CDs. So they won't make that extra $200. They'll actually extend the loan. So you have those two risks. Whatever people do, that's what you're going to get passed through to you. All right. So if you have mortgages that are paying 8% and interest rates drop to 4%, you're going to get a bunch of cash from your investments. You're hoping you're going to make 8%. Now you got all this cash. You look around and say, what are you going to do with this cash? And now all you can do is invest at 4%. You're kind of upset. If you bought the treasury at 7%, you'd have 7% locked in. You'd be happy. Instead, you bought the mortgage back. People prepaid. Now the best you can do is reinvest at 4%. Questions on this? There's no way y'all can all understand this yet. This is a lot, right? We're not supposed to cover this undergraduate, but you need to know this. This is pretty important stuff. We hit it. I'm going to show you on the exam what you need to know, but this is really, really important stuff. You can make this your career. If you become a mortgage-backed investor, this is what you have to know this stuff backwards and forwards. And I'll tell you the story of people who don't know this backwards and forwards. They got themselves kind of in some trouble. So mortgage-backed securities usually have negative convexity. Remember positive convexity? The line goes out like this. Bonds do better than duration, whether rates rise or fall. What happens to the mortgage? Interest rates fall. That looks good. Your mortgage is going up in value, right? You have this 8% mortgage and interest rates are now 6%. Well, what happens eventually? People prepay at 6. So your bond price can't go up anymore. Why? Because you got all your money back at par. So the yield, the curve goes sideways. See if I can show you this using the now remember this guy. Oh man, why is that taking so long? But questions? If you get the Pabozzi book, it's an entire chapter.
So does that mean that it has less risk or how does that work?
It actually has more risk and you're getting compensated for that. So a normal bond that doesn't have embedded options, that's what its price looks like. Versus duration, you have positive convexity. The bond actually does really well. When rates rise, the price falls, but not as much as duration says. When rates fall, the price goes up more. What happens to the mortgage-backed security? Well, when interest rates fall, its price does go up. But at some point, it's actually going to go straight across because you're just going to get your principal back. If they owe you $300,000, that mortgage isn't going to go up to $350,000, $400,000 because they're just going to pay you to $300,000. So eventually it goes sideways. If it goes sideways, then the green line is below the blue line, and that's negative convexity. All right. So bonds with embedded options have negative convexity. You need to be paid for that risk. We do say it's a risk, maybe not everybody says it's a risk, but it's definitely something that's not to your favor. So that's negative convexity. I can't model that here because this only does non-callable, non-embedded option bonds. That's all he has set up here. So the degree of optionality in a bond is going to determine its convexity. So callable corporate bonds, they may not be negatively convex, but it may have really low convexity. I think I showed you the long treasury had like a 900 convexity, and mortgage back might have like a negative 300 convexity. Which is it's just not in your favor. And a callable bond might be at 0 or something like that. So what would you do tactically? So we're going to give you some tricky terms. If you expect interest rates to become more volatile than what the market is currently pricing in, you don't want mortgage-backed securities. You want to avoid those. So you want to buy convexity. What does convexity mean? You want to buy convexity means you want to buy bonds with high convexity, non-callable bonds. So if you expect rates to be really, really volatile, mortgages are not your friend. All right. If interest rates right now are really volatile, but you think they're going to settle down, remember, interest rates are really volatile. You're getting paid a higher spread because of that optionality. You're getting compensated for interest rate volatility. So if interest rates settle down, you get this really great starting yield, and you get to keep it because interest rates settle down. In that case, you want to buy mortgage-backed securities, or if you really want to show off in an interview, you say sell convexity. What does sell convexity mean? It just means buying mortgage-backed securities. So selling convexity means buying these mortgage-backed securities. And why do we say that? Because essentially you're going negative convexity. But why would you do that? This is important on the exam, especially the second question. Why would you do that? The only reason you do that is because you get that higher yield to start with. If mortgage backs and treasuries had the exact same yield, just buy the treasury. There's no reason to buy the mortgage back. But if treasuries are paying 6% and mortgages paying 6.7, and that's a really good rate because rates are really volatile now, and then rates settle down. If rates settle down, you're going to keep that extra 0.7%. You're getting a lot of compensation for taking on that risk. So in an interview, you say, hey, man, interest rates have really been volatile. I think they're going to settle down. I'd be selling convexity right now. I think I'd be loading up on some Ginnie Mae's and Fannie Mae mortgage-backed securities.
So what does interest rate volatility look like? Because like if you look at what the Fed's doing, everyone knows that the Fed's gonna cut.
Well, we're talking about the 10-year. So it's just a standard deviation of the 10-year yield. You can't just really go in and just look at the standard deviation of the 10-year yield. It's just like when we'll talk about the stock options. It's just the volatility of the stock that you're looking at. Those stocks, when the stocks get really volatile, right around earnings announcement dates. So option prices get really expensive if a firm's going to be issuing earnings during that time. That's just because the stock price is more volatile. So treasury yields, I haven't looked, we could calculate it. Maybe I'll calculate it for next class, but treasury yields, maybe they're more volatile right now. You could actually, but you really could just do a 90-day standard deviation of the treasury yield and see if they're getting more volatile. All right, this is a tough thing to understand. Make sure you have this. You only buy mortgage-backed securities because you want that higher yield. There's no reason to buy these securities if they don't pay that extra return. Now, these came out in the early 80s. When they came out, people didn't really understand them, and they were really volatile. When they first came out, extremely volatile. They were actually as volatile as stocks when they first came out because of different law. So how important is this? So I'll tell you my story. This is like one of the most important parts of my job at USAA. I still remember, I don't have nightmares about it anymore. I still have nightmares about other parts, but not that one. But I was in this department where they said, okay, Ron, you're going to be in this department. There's only 4 of us. And they had the head of equities, Stuart. I took his place several years later. Stuart came in. We had the development guy from real estate company, and then me. We had 3 guys, a stock guy, a bond guy, and me. I mean, a stock guy, a real estate guy, and me. So supposedly I'm the bond guy. My bond knowledge was part 2 of the CFA exam. And talking to Dr. Misery here at UTSA. But I understood all this stuff because I've been reading about it. And so here's this department. Well, USAA is, 70, 80% bonds. So they have me as the peon guy. All the other, if you walk through the department, I looked like the guy who got coffee. As the senior vice president, he had this massive office. The guy from real estate company, he was an executive director. He had this big office. And then I was sitting in this cubicle about the size of this thing. But I was responsible for the big part. USAA at that time, amazingly, had 70% of its assets in mortgage-backed securities. Absolutely insanity. In my department, we were supposed to come up with a new strategy for USAA. And guess what my recommendation was for mortgage-backs? Anyone want to guess? I recommended 0. All right. And the investment company went crazy. Now, I had a bunch of friends in the investment company and they're all on my side, but they're too scared to say anything because the president of the company and the 2 senior vice presidents, they love mortgage-backed securities. So I recommend 0. The president of the investment company writes a letter to the USAA board of directors complaining about me that I should be fired. He doesn't know what he's doing. He's all textbook. It was exactly right. I was 100% textbook. I bought 1 treasury in my entire life. He was exactly right. But the advantage I had was the guys that were buying these mortgage backs, they had all their training in bonds in the 60s and 70s. My training was in the 90s, which still seems like a long time ago. So I was learning all this stuff. They had never heard of this stuff. So he wrote a letter to USA board complaining about me. I didn't understand these bonds. He actually said these bonds do better when interest rates are volatile, which like was crazy, crazy, crazy. So my boss said, Ron, you write a letter to the board challenging them. Why did you do that? Because he didn't want to be associated with this at all. He wanted to make sure someone's going to get fired. I got fired and he didn't. So I had to write a letter to USA board of directors. I didn't complain about the president of the investment company because he's a lot more important to me. I was just an analyst, but I just stated what the textbook said. So this is my argument. Learning what's in the textbook is pretty powerful. And I think what saved me, USAA sold all its mortgage banks. So I won the argument. What saved me is USAA had just hired a new board member. The guy's name was Ed. He called me and said, I want to talk to you. And I'm saying, you know, I'm a PR. Why do you want to talk to me? But he comes, I could see him coming. His face was about as red as it could be. So he was mad. He was either mad at the investment company's president or mad at me. I didn't know which. And he comes up, he's really, really mad. And he was mad because they hired him because he knew fixed income. He knew this stuff. He was mad because he couldn't believe a firm as sophisticated as USAA had 70% of its money in mortgage backs bought by people who hadn't studied bonds in 30 years. That's what he's, so I'm like, so I won the argument. We got out of mortgage backs. I didn't get any promotion out of it, but 2 years later, Standard & Poor's started downgrading any firm with a significant exposure to mortgage backs. And by significant, they meant any firm with more than 10% in mortgage backs. USA had what? 70%. Can you imagine? Fortunately for us, Standard & Poor's, they can go back historically to look what people had. So, but a friend of mine, we were talking about this. I was kind of famous in the investment company because they're like, this guy's going down. There's no way Ron's going to survive this. And I survived. So I kind of was like, kind of folklorist there for a while. But I was like, I don't know any better. I'm just saying what the textbook says. But we were talking, what if I'd lost the argument and USA still had 70% in those bonds? And the ratings, he's come in and they quiz the investment company's president on why do you have mortgage backs? And he's saying the opposite of what the textbooks say. It could have been a disaster for USA. So USA kind of dodged the bullet there. I know a lot of students don't read textbooks. That's all I did was read textbooks on this. That's all I knew. And boy, it was huge. I was calling my friends in the investment company, like, okay, this is what I'm saying. This is what I learned. Am I saying that correctly? You get kind of nervous, right? You're going to sell $20 billion in bonds and you're pushing this and people are like, this guy should be fired. So this is really important stuff. Why was USA doing that? Because they saw this highly rated bond that was paying a really good yield versus treasuries. It's like, wow, this is a AA, AAA bond. It's paying a much better yield than even BBB bonds. What were they missing? They were missing that negative convexity. So,
why did he say that they weren't better bonds?
I don't have his memo. I should have kept it. I should have photocopied all of that, but I don't have it. I wish I did. It wasn't an argument, made a lot of sense. It sounds like something you might hear like in a presidential debate or something like that, where you're like, what did they just say? I don't understand that. It was kind of just garbly goofy him just saying something, because he knew that was what my argument was going to be, but they were buying these things on yield. Why? Because that's all they knew. They knew credit ratings and they knew spread. They had to be highly rated bonds that were paying these really great, and they do. These bonds versus, you know, these are AA, AAA bonds. They're playing amazingly high spreads versus other AAA, but that's because you have this massive risk on the other side. So yeah, you have to. One of the arguments they did make, which made no sense to me at all, but in 1992, USA had Hurricane Andrew, and the guy running this portfolio, he said, see, Ron, we paid all of Hurricane Andrew and we didn't have to sell a single bond because they were getting all these mortgage-backed prepayments. So the argument he was making, which made no sense to me, is we'd rather pay off this hurricane with bonds at 100 that came back to us at par versus paying off selling bonds at 110 because interest rates have fallen. Does that make sense? Would you rather get $100 to pay your claims or sell something for 110 to pay your claims? That was the argument he's making. That made no sense to me at all. But that's all right. You say we have to sell a bond. I was like, why do you not like selling bonds? You got $20 billion of bonds sitting there. You can just sell one. So their arguments didn't make sense, but this was old school. This is the other thing of becoming a dinosaur. So the guys at Victory Capital now, the people that followed that group, because that whole group retired and went on, they knew all this stuff extremely well. But they didn't want to say anything because they were scared of their jobs. I was in another department. I was like, I don't care. I was wealthy enough that they fired me. I was saying, I'll go do something else. So I wasn't that worried about it, but they were all kind of shocked that USA had those exposures as well. It made no sense to them at all, especially the life insurance side. These bonds are a disaster for life insurance companies. And the life insurance company at USA had 60, 70% of these as well. The actuaries and life side were like, they were cheering for me. They weren't going to say it out loud, but they're like, I hope Ron wins, because they were desperate to get rid of these bonds. And so they were very, very happy. So I was just a person that just happened to be there at that time. Sometimes you got to step up when you're ready, but don't become a dinosaur. So if you're in this, what did these guys do wrong? They stopped reading. That was their job, and that's what they did. They should have been reading the portfolio and the journal of fixed income portfolio management or whatever. They should have been reading this stuff. UTSA had Dr. Misra. He's retired. You all have missed out not having him. I think he's the best finance professor in the state. Really great finance professor. He knew this stuff backwards and forwards. And so the actuaries in the life insurance company hired him to come teach a mortgage-backed security course at USAA. And so I got to go through that and learn them. And that may be one of the reasons I'm teaching here. I got to know him pretty well. So I had him on my side, and if he was agreeing with me, I knew I was in good shape. He was a really brilliant guy. But read. There's times you're going to walk into, well, some of y'all may be this with AI and Python and all this other stuff. You're going to be walking in with some 40-year-old that's your manager who doesn't know any of this stuff. You're going to have this huge advantage because you got the new, but what's going to happen 10 years later? You're going to be the old guy and the new people are coming in. You better be keeping up as the new person and reading. You just got to read all the time, constantly. Find those podcasts that are talking about these kind of things. There's probably a mortgage-backed security podcast out there somewhere. All right, questions on that? One of the most complicated parts, we can't even scratch the surface, but to me, really, really exciting. What you have to do with this, you have to understand interest rate theory. Far deeper than they teach you in eco class. Why do interest rates change the way they do? Why does long end of the curve do certain things? Someone was asking me about yield curve steepening or going more narrow. Is that you, Tristan? We talked about a bull rally or a bull steepening or a bear steepening. Those are all really good terms to know. There's so much more that you can do with fixed income. So I moved $20 billion of USA's bonds just because I took part 2 of the CFA exam. That's kind of scary. You think the USA wouldn't need that. I wasn't the only one there that knew that stuff. There was a bunch of them. I was just the one that just happened to be in that position. So you got to be ready when the time comes. All right, let's talk a little bit easier topic, which is credit. So credit is how much you're getting paid to compensate you for the chance that person may default, but they can't pay you. They go bankrupt. That's credit. And that's just kind of normal spread. It's the probability of default. You can look at credit rating agencies. AAA is the highest. D is the lowest. Y'all know where investment grade and below investment grade switch. What is double B? Is that investment grade or below investment grade? Below. Double B, what's triple B? Investment grade. All right, so that's the split. Triple B is investment grade, double B is below investment grade. All right. John, who's still working for Victory Capital, he would call triple B minus, he called them cuspy bonds. They're right on the cusp. One downgrade, they're in below investment grade. That makes a big difference. When you move from investment grade to below investment grade, that's huge because you're moving portfolios. You have investment grade investors and you have high yield investors. When a bond moves from one to the other, it disrupts everything. It's a whole group. This group's got to sell it. This is a different group. It's very, very different. investment grade people sell between themselves all the time. When something gets downgraded to below investment grade, it changes the whole dynamic pretty dramatically. High quality. So we're going to think high quality, medium quality, and low quality, or high quality, medium quality, and junk, or high yield. Below investment grade, there's all these terms for the lowest quality. So below investment grade, junk bonds, high yield bonds. What do the mutual funds call them? If you're buying these bonds, what would you call it? Would you call it the junk bond fund, the low investment grade bond fund, or the high yield bond fund? Which sounds best to you? I might call it the high yield bond fund. That might be my term. So they have a bunch of different terms. I won't use the term Cliff used to call these bonds. He didn't like them. I can't use that term in front of y'all. But so the lower the quality, and here again, we got to use which word? Y'all see this word here? We don't say the biggest, the spread. We say the widest. And the higher quality bond, the narrower. And I don't know who came up with those terms. So spreads widen, and they narrow. They don't go up and come down. They widen and narrow. Right. So in an interview, use those terms. I think we're going into a recession. Boy, we're going to see credit spreads widening in this recession. Don't say you see credit spreads going up. I may be okay, but widening's term for some reason that we use. So low quality bonds are going to have the widest spreads. High quality bonds are going to have the narrowest spreads. The main way we measure that is through credit ratings. Moody's and S&P, even after what happened in 2008, they're still the two predominant rating agencies. In fact, Moody's is a really good stock to own. I don't know if y'all know the term economic moat. But Moody's has a very impressive economic moat. They have a very high returning company, and the competition is kept away because they have this reputation for being really, really good. So it keeps the competition out. So I've worked a lot in my career with Moody's and S&P. Did a lot of presentations to them on the investment side. So I kind of got used to them. Good friend, the first person I worked with in finance, a lady named Lisa, she left USA, she got married, and her husband was a hedge fund manager, then moved to New York. She took a job at Standard & Poor's. So I went and visited her. And it was kind of interesting what that kind of job, if you want that job, it's a great place to work because the building's right there where the bull is in New York, and on the bull. So you get a picture with the bull every day if you can wait for all the people in mind. So I was kind of curious how that job went, and she showed up to the job. The guy before her just quit. There was paper stacked up 10 feet high. They said, "Here's your office." And that was her entire training. "Here's your office" was her training from Standard & Poor's. And she was rating life insurance companies, which is her background. And I said, "No training else?" She said, "No, I analyzed my first company. I wrote the report and I asked anybody want to review it." I said, "No, just publish it." Like, "Oh, okay, I'm the new person. You want me to publish it?" So yeah, just publish it. So that's not the job you want right out of college, because it's pretty scary. I could not have done that. Could y'all have done that? Zero training here, figured out on your own. She was very, very smart. So she figured it out. She did a lot better than I would. I was very, very fortunate she was there when I started finance, because a really good person to work with, but smart person. But these are tough jobs, but if you can do them, you're set for life. You don't want to work for them more than 2 years because they're horrible, horrible jobs. But once you get that on your resume, you are set for life. They are great. It's kind of like investment banking jobs. Let me show you some history here. Haven't updated these in a while, but that's all right. All right, I love this chart. You should almost want to have this in your wallet. So these are the spreads. This is actually 0.3%, so that's 30 basis points for AAA, AA, single A, triple B, and high yield. So AAA bond pays about 30 basis points over treasuries on average. 30 basis points. So if treasuries are paying 5%, you'll get 5.3% on this bond. Double A about 83 basis points, single A 121, triple B 178, high yield 494. Right? That's the average. The median's pretty close. The 10th percentile look at high yield, the 10%, that was 300 basis points. You're only getting paid 3% more than treasuries. I would never buy high yield and make 3%. What's the 90th percentile? 700 basis points. I bought high yield at the beginning of 2009. Why did I do that? They were paying 18% spread. Like, yeah, that's even better than the stock. So yeah, I'll take that. And high yield was up 70% in 2009. The stock market was up 70%. But if you graph the two of them, high yield went up like a straight line. Stock market went up like that. So high yield gave me the same return as stocks, but with very few bumps and bruises along the way. So that's 2008. 2021, just recently, we hit some all-time lows. So in 2021 was a horrible time to be buying bonds because you just weren't getting paid much for the risk. You probably should have just bought the treasuries. But even treasuries are terrible in 2021 because the yields were just so low. Nothing was good in 2021. People were just desperate for yields. They were buying corporates just to pick up an extra 12 basis points. I mean, it's just not worth it. This is the current, but that's a few years ago. So I need to update this. I do this in Bloomberg. And Bloomberg has these tickers for the AAA, AA, single A, and you can bring in the spreads. And you notice what spread is bringing in. Anybody notice what spread that is? It's the OAS spread. It's not the actual spread, it's the OAS spread. So they're taking out the effect of the optionality. So this is what the bond spread is once you subtract, and that optionality is pretty subjective. Now here we're only talking about callable bonds. This isn't mortgage backs. They're not in here. So we're talking about corporates here, but you've got AAA. The tickers are ridiculous. I don't know who came up with these tickers, but tickers are ridiculous. But you can, using those tickers, bring in spreads. It's giving me an error message because I'm not on a Bloomberg machine, but if I were on a Bloomberg machine, I could get those spreads back so you can look at them. This is one of the things you want to know because if you're looking at bonds today and you see that today spreads are a little low versus history, especially high yield. This time, high yield made no sense to me at all. You're getting paid 400 basis points when you normally get paid 500. And in 2021, that seemed like a really risky time. People are talking about, are we going to a recession? What's going on with the pandemic? Why are we getting paid so little to take credit risk? Because it seemed like there's a lot of risk. So it just didn't make sense to me. But I think a lot of it is because interest rates are so low, people are just desperate. Give me something with some kind of return better than 0.4% on treasuries, and I'll take it. So it was kind of a desperation. We call it stretching for yield. So this is a great chart. Maybe I'll update it and show it to y'all so y'all can see how it looks in today's terms. Oops. So here's the categories. High quality, all the A's are high quality. AAA, AA, single A, that's high quality. Triple B is what I call medium quality, and there's a lot of triple Bs. That's a very, very large category. S&P is all capital letters with plus and minus signs. Moody's is a capital and two small letters with 1s, 2s, and 3s. And then for some reason, Moody's for triple B, they do BAA. You might hear BAA sometimes, or BA. But S&P is 3 capital B's. Moody's is a capital B and 2 small A's. Looks like the word ball, like a sheep would say. So triple B, you might say, if you hear BAA, I don't know why some of this triple B is a more common term you hear. So you can have 1s, 2s, and 3s, pluses, minuses. So the highest quality bonds are going to have the narrowest spreads. Medium quality will have a spread quite significantly higher than that. And in low quality, they're going to have the highest spread, the widest spread, the widest spreads. These junk bonds are sometimes referred to as hybrid securities because when times are pretty stable, they look a lot like bonds, but when times get volatile, especially in recession or stock markets going crazy things, they can look a lot more like stocks. Like in 2009, they look like stocks. They do really, really well in strong economies. They do really badly in recessions, just like stocks. So you don't want these bonds if you're expecting a recession. We're going to ignore preferred stocks, but just for our purposes, preferred stocks are not stocks. Preferred stocks are bonds, right? Stock investors don't buy preferred stocks. Bond investors buy preferred stocks. So what is preferred stock? Well, preferred stock was some companies thinking they could trick the tax code if they reclassified debt as a stock. So let's say instead of calling it debt, let's call it a stock. That way we can get special treatment. And the IRS said, no, you're not going to do that. And so it kind of fell apart. But there's still preferred stock issued. In fact, Freddie Mac and Fannie Mae had some preferred stock that blew up in the crisis. So, but a hybrid preferred stock's also somewhat of a hybrid, but it can be more like a bond even in high yield because sometimes some of these preferred stocks are pretty high quality, pretty safe securities. So, but don't think of preferred stocks as stocks. Think of them as bonds. So here's where it gets tricky. And all right, so we don't have much time to get in. We'll get into this more next time, but here it gets really tricky. What do interest rates do when we have a recession? Do they rise or fall? Fall. What's the Fed going to do if you have a recession? They can cut rates or raise rates.
Cut rates.
Cut rates. So you expect in a recession rates to fall. What happens when you come into a strong economy? You expect rates to rise. You might have inflation. The Fed's going to show that. So recessions and falling interest rates go together. What are credit spreads going to do in a recession? Are they going to widen or narrow? They're going to widen. All right. So in a recession, you expect rates to fall and spreads to widen. All right. So what does that mean? In a recession, you want to lengthen out duration. Why? Because rates are falling. And you want to move up in quality. So if you expect a recession, would you want a 5-year BBB bond or a 10-year treasury? 10-year treasury. All right. It kind of seems obvious, but you have to when you're looking at it, because on the question 2 on the exam, I'm going to tell you if you're expecting a recession. So that's going to tell you 2 things. A recession means interest rates are expected to fall and credit spreads are going to widen. If you're expecting to come out of recession with a strong economy, you would expect rates to rise and credit spreads to do what? Narrow. All right. So you have to keep that in mind. So if your boss says, I think we're going into recession, that implies the treasury yields are going to fall and spreads are going to widen. So you want to increase quality and lengthen duration. You have 2 things there. Now on the exam, I will usually tell you if rates, it is possible to go into recession and rates don't fall. We had that in the 70s. It's possible to have a strong economy and rates don't rise. We had that in the 80s. I'll talk about that in the next class, why the 70s and 80s are such an unusual period of time. But normally, strong economy, rates are rising, spreads are narrowing. Weak economy, interest rates are falling, spreads are widening. So keep that in mind. That's pretty important. And so we'll see. We'll do this chart next class to show you the different combinations. All right. I was going to read some articles today, but I do have those articles attached. The first 8 or 9 articles, you might read through the highlighted to help you with paper 1. Is your paper 1 going okay? Anybody got it finished yet? Not due for a couple of weeks. So one thing I will do is I want to volunteer. See if we get one. I haven't had trouble finding one in the past. And if you write your paper and finish it early, I'll mock grade it in class without your name on it. So everybody can see how I graded your paper. And what most students do is they come to me with their paper first before I show the class. And so it helps the class a lot to say, oh, you forgot to put that in there. And that helps them. So if anyone wants to do that, I've tried having a class grade each other's draft paper, but that's too stressful. So if you're in that category where you want to show off your writing skills, then let me know and I can do more than one. So let me know. All right, I'll stop it there.